All right, everybody. Welcome back to Strongman Personal Finance. I am Christopher Bell, certified public accountant, long-term boglehead investor, and hater of frauds on YouTube that pump worthless garbage stocks and mislead people into making horrible financial decisions. Now, in this lunchtime video, ladies and gentlemen, we are not attacking any YouTubers. I actually want to discuss something that's very important to me, and that is diversification. Now, if you have any sense of investing, you know that diversification is key. You want to be exposed to more than one company, because if one company goes down and that's all you're invested in, you've lost all of your money. So diversification is the key to long-term investment success. It doesn't matter what company you're invested in. It could be the best company in the world. It doesn't matter, because something could happen unexpectedly and that company could have serious trouble and maybe go out of business. It's happened before and it'll happen again. Now, a lot of people, they think, well, diversification is good, and which it is, and they want to keep the majority of their portfolio in, let's say, the S&P 500. There's two main ETFs that you can buy. There's the VOO or the VOO ETF. That's ETF provided by Vanguard. That is the S&P 500. And the SPY, the SPY. That is another S&P 500 ETF. The thing that worries me is that a lot of people think that to get true diversification, all you have to do is put the vast majority of your portfolio in one of those two ETFs. Now, historically, if you had invested in the S&P 500 and just held it and let it ride, you would have done phenomenally. You probably would have had a 10, 11% return. Compounded every year, which is fantastic. But what worries me is that people seem to ignore international and emerging markets investing. They believe because the US stock market has done so well over the past decade or two that performance is going to continue into the future. And they feel like they don't need to invest internationally. Well, I disagree. I think if you have the vast majority of your portfolio, 95, 100% of it in VOO or the S&P 500, I think you are not sufficiently diversified. I believe you should invest in a total world stock market index fund, such as VT, or that's an ETF, in a tax advantage account, because you get exposure to the entire world. Now, I'm going to show you a couple slides, couple things I looked up to argue why it is not a good idea to just YOLO all your money only in the US stock market. You need international diversification. Now, the first thing I want to look at is, or I want to show you, is how VOO and SPY, the S&P 500, those ETFs exclude the vast majority of the stocks in the US stock market. Now, VOO takes up a lot of market cap. It's the biggest 500 companies in the United States. So the vast majority of the market's capitalization in the US is the S&P 500. But if you invest in VOO or SPY, you're missing out on over 3,000 small cap and mid cap stocks, which historically have done pretty well. So right off the bat, if you're investing in the S&P 500 and nothing else, you're missing 3,000 stocks that have historically, sometimes they've done bad, sometimes they do well. The market goes in cycles. So let's go look and compare these two different indexes. So the first one on the left here, let's see if you can see my screen. Yep. On the left here, we have VOO. This is Vanguard's S&P 500 ETF. So if you invest in VOO, you buy one share of VOO, you have 508 of the largest stocks in the United States. Now on the right, we have VTI. VTI is the total US stock market ETF. And that also includes 3,100 small and mid-cap companies that are excluded from the S&P 500. So you can compare the difference. Look on the left. You're only investing in 508 large U.S. stocks. Where on the right, if you went with VTI, you're also factoring in an additional 3,100 small and mid-cap U.S. stocks that are excluded from the S&P 500 index. Now, I can go and look at historical charts, or I can pull them up in another video. But different categories of stocks go into different cycles. For example, large caps might do good for a decade or two. Small caps might do good for a decade or two. Mid cap stocks might do good for a decade or two. Now, if that's the case, if that's the historical record, why would you exclude small and mid cap stocks from your portfolio? That is why, if you're just huge on the US stock market and you don't believe in international investing, I would recommend that you diversify even more by putting your money in VTI. That is the entire US stock market. You're not excluding almost 3,100 companies like you would if you invest in VOO. I don't care what the historical performance of VOO or the S&P 500 has been in the last couple of years. It doesn't matter to me. I'm looking to the future. And in the future, large cap stocks in the US might not do as well as other asset classes. Investing is not about looking at the past and basically extrapolating those returns into the future, because investing goes in cycles. Maybe the US has peaked. I don't know. I could be wrong. Maybe VOO maybe VOO will do very well and continue to dominate. But you don't know for sure. You don't know how to predict the future. So I say you hedge your bets. And if you're going to invest in the US stock market, I would put your money in VTI. You get a lot more exposure. Now, let's jump over to Fidelity, and I'm going to show you basically the average price to earnings ratio of the VOO ETF. Now, price to earnings is basically how much money you're paying for $1 of earnings. It's based on, well, you have different types. You can look at forward PE, which is a guess, and you can look at, the trailing price to earnings ratio. But basically, it's when you see a PE ratio, it's how much money you have to pay to buy $1 of earnings. So here on Fidelity, we're looking at the VOO. This is just the S&P 500. Go down, blah, 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 blah. Obviously, it's had a great run. I'm not denying that. But if you go down and you look here on the bottom right, let's see if I can zoom in a little bit. Where are you at? There it is. It's on the bottom left now because I zoomed in. Yeah, there's actually a couple fundamental, basically, ratios that you can look at. For example, the price to earnings ratio. This is how much you pay for $1 of earnings. So if you bought VOO right now, basically you have to pay $27.61 to get $1 in earnings. That is what the price to earnings ratio is. And then there's other metrics here: price to books, price to sales, price to cash flow. The price you pay for a security basically determines, not always, but it kind of determines your future expected returns. Because if you pay $100 for $1 of earnings, you're going to get a 1% return, okay? Where if you pay $50 for earnings, for $1 of earnings, you might get a 2% return. So price to earnings ratio, while it's not the only metric, there's tons of metrics you can look at. It's something that you need to consider when you're buying securities. So VOO is pretty expensive historically. I think the average for the US stock market is like 15. So we're in very expensive times, and that's principally because we have low interest rates. So VOO has a price to earnings ratio of 27.61. Now let's go look at international stocks, which is under the ticker symbol VXUS, and see what that price to earnings ratio is. And that'll give us a quick snapshot of whether international stocks are more expensive or less expensive right now. So we go to the top, VXUS. Oh, come on. Don't do this to me, Fidelity. There we go. Now, VXUS is another ETF provided by Vanguard that tracks all the other stocks that are outside the United States, because there actually are countries outside the United States, if you didn't know that. And these countries have great companies that you can invest in. So don't get fixated on the US, ladies and gentlemen. So we have the Vanguard Total International Stock Index Fund, large blend equity ETF. So let's go down and see what the price to earnings ratio is. Oh, Morningstar, 3-star rating. I guess I can't buy it now. I don't care. So I'm looking. All right, here's some of the stocks that are in it. Taiwan Semiconductor, Tencent, Alibaba. You're exposed to the rest of the world, and these are all fantastic companies that you can consider investing in. All right, you're exposed to Asia, Europe, North America, Latin America. You own the entire world outside the US if you buy this one ETF. Now, price to earnings ratio, look at this. It's cheaper. It's $20. So you would have to pay $20 to get $1 of earnings with that price to earnings ratio. So just looking at PE ratio and then look at the price to book and price to sales, price to cash flow. Those numbers are all lower, which means on a fundamental basis, you are buying earnings at a lower cost than you would in the United States. These things go in cycles. When a market has a massive bull run, you're going to have higher price to earnings ratios, depending if the market is, growing faster than, or the market cap is growing faster than earnings are. So look, right off the bat, you can see VXUS, cheaper. Now, does it mean you need to put 100% of your portfolio in VXUS? No, it doesn't. Because even though the trailing price to earnings ratio for VOO, the US stock market, is higher, maybe earnings in the future will catch up to that valuation. I don't know. But just looking at this right off the bat, international markets are cheaper on a fundamental basis. And fundamentals ultimately matter in the long run. I don't care if you're day trading AMC or GameStop. I don't care. Fundamentals in the long run are what truly matter. So that's VXUS. Now we can actually look at emerging markets. That's VWO. That's specifically like China, Russia, blah, 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 blah. It's highly volatile, this ETF, but it does give you exposure to things outside the United States. And it kind of excludes like Japan, Europe, basically developed markets. So looking at Vanguard Emerging Markets Stock Index Fund, this is international companies as well, but it's a narrower band than VXUS. Here's some of the stocks: Tencent, Alibaba, Taiwan, some stuff I can't pronounce, but it's mostly concentrated in Asia. Now looking at this price to earnings ratio, 17. So on a fundamental basis, emerging markets are also cheaper than the United States. Now, the whole point of this is you don't know what the future holds, but just looking at the fundamentals, other asset classes are cheaper. That means you don't have to just go ahead and YOLO all your money into VOO or the SPY, because fundamentals matter. Instead of putting all your money in one country, why not own the entire world? So let's go ahead and look at the VT ETF, which is the one that I'm always supporting on this channel. The VT ETF, you are exposed to the entire world at market cap weights in one fund. So you don't have to worry about timing the market or, is US overvalued? Is emerging markets undervalued? Should I reallocate my portfolio? This fund is weighted for market capitalization. So if international does well, it'll grow as a larger percentage of your portfolio. If US keeps doing well, you'll have exposure to that. You're exposed to everything. You're buying everything, so you don't have to worry about timing markets and moving in between funds, which is also tax inefficient. So this is the Vanguard Total World Stock Market Index Fund. It's an ETF, which I love this. This is 100% of my wife's Roth IRA, by the way. That's all you need. All you need. Just buy it, hold it forever. So looking at it, here's the companies that you own in VT: Apple, Microsoft, Amazon, Facebook, Google, Tesla, JP Morgan, Tencent, Johnson & Johnson. You own US companies and international companies. And it has 9,000 stocks. That is peak diversification. Now look at your country exposure. You have North America is roughly 60% of VT. So if I'm wrong, and I could be wrong, maybe the S&P 500 and the US keep dominating going into the future, 60% of your portfolio is still in the US. But you also have exposure to Asia, Europe, Latin America, even the Middle East and Africa. Okay, so you own everything. So if Asia somehow dominates, which is highly possible going into the future, this percentage, this 18.99%, will grow as a percentage of your portfolio, and you will reap the rewards from that investment. And don't worry about the ratings and crap. Like, is there like a Morningstar? I don't care what Morningstar says, okay? Funds people update their ratings of funds all the time. So to me, it's irrelevant. It's more about understanding, what are you buying, why are you buying it, and where is it going to be 30, 40, 50 years from now? Look at this expense ratio, 0.08%. You own the entire world, and it's basically free. I mean, you got to pay some money, but it's basically free. It's amazing. I've never seen a better product for a new investor to put their money into in tax advantage accounts in my entire life. But you can invest in AMC, ladies and gentlemen, and Tesla. I'm sure you're going to do extremely well. You sense the sarcasm there? So that's the VT ETF. Now, I have another argument to show you why I don't think it's a good idea to invest in one country. So this is a stock market image, this is the Nikkei 225. It's basically the largest 225 stocks in the Japanese stock market. Now, decades ago, everybody thought Japan was going to take over the world. Japan. And they had a massive freaking bubble, as you can see by this chart. And it looks like it popped in the late 80s. So you had this massive run up, and everybody was like, oh my God, Japan's the future. Invest in Japanese stocks. And look what happened. Valuations got so insanely high. There was so much speculative madness that the market crashed. And look what happened. Look how long it went down. It went from the late 80s. God, I mean, it still hasn't recovered now. So you're looking at 3 decades of flat or negative returns if you had solely concentrated your money in the Japanese stock market. Now, will this happen in the United States? I have no idea. Is it possible? Absolutely. So if you're highly concentrated in one country, this is a distinct possibility. This could happen. But if you had owned the entire world, ladies and gentlemen, okay, maybe the Japanese stock market craps the bed. Well, your wealth isn't going to be wiped out because you actually have exposure to other countries. And you have to look into the future. What countries are expanding, growing at rapid rates, going into the future? So do not concentrate your entire portfolio in one freaking country. And I mean, look at it. You can't deny this. And like back in the day, I used to only have US exposure. This freaked me out. And I was like, this doesn't make sense. Why would I only put my money in one country? Now, here's another argument. I have another thing to show you why you should diversify your holdings. Now, this chart right here shows US versus foreign stock performance in a rolling 3-year return. So when you see blue, that means US stocks have done better than international stocks. And when you see, I guess, orange or red, that means that international stocks have outperformed. And this goes all the way back to 1969. So look at the fluctuations. US does well for a little bit. International does well. US does well. International does well. US does well. International does well. Do you see the trend here, ladies and gentlemen? So if you have myopia, like let's say you started investing in 2011. So you're looking here towards the right. And you see, oh, look how much the US has dominated. Well, you're completely ignoring historical returns, which has shown that this goes into cycles. Do you kind of see the cycle here, ladies and gentlemen? You want to be exposed to the entire world. You don't have to worry about timing these cycles because you're probably going to screw it up if you try to time these cycles. But to me, it looks like, and I could be wrong, but it looks like international might have its day in the next couple of years. I don't know, but it's a distinct possibility. Look at it. 1969 to 2016, there's been consistent and pretty clear cycles of US or international outperforming. So why not just own them all, ladies and gentlemen? You're not smart enough to predict these cycles. I'm not. No one is, because nobody truly knows. Now, that is it, unless we have any questions. He's such an idiot. If you're subscribed to me, Kevin, unsubscribe. He's a moron. He says buying index. Oh, it's boring. Yeah, okay, me, Kevin. See, if he's telling that to his fans, he's a piece of garbage. You should have 95% of your portfolio in index funds in tax advantage accounts. And the remainder, you can do whatever. You can buy Bitcoin, AMC, Tesla, whatever you want to do. But 95% of your portfolio should be in broadly diversified, in my opinion, total world stock market index funds. Now, I hope this demonstration proved to you, ladies and gentlemen, that the U.S. isn't just a super ultra dominant thing that's going to crush going into the future. You don't know. That's why you want to diversify. So please do not concentrate your entire portfolio just in VOO or SPY. It's not necessarily a good thing. I could be wrong, but at the end of the day, I am more confident that I will build long-term wealth by owning the entire world as opposed to concentrating my money in one country. But that's it, ladies and gentlemen. It's ultimately up to you. You can do your research and determine what you want to do. But at the end of the day, I have VT as the vast majority of my holdings. and I'm comfortable with it. Now, if you like this video, ladies and gentlemen, hit the like button, subscribe to my channel, hit the bell button for notifications. Consider buying my book, Stop Being a Broke Loser. It's on Amazon for $3. I know I'm exploiting you. And y'all have a wonderful, delicious day.